Hello everyone, and welcome to our first educational course at PKStockPicks. My name is Parth, and I'm the founder of PKStockPicks. Today, I'll be talking about a topic that's on everyone's mind: inflation. Inflation is affecting everyone throughout the world, and I'm going to teach you how to master the market during inflation. Specifically, I will cover the following topics: what inflation means and how it affects everyone's lives, how inflation affects the stock market, how to analyze important indexes and determine current states of inflation, what sectors are risky during inflation, and what sectors are safe havens during inflation. What is inflation now? Inflation is normally considered an increase of the costs of goods and services within an economy. And inflation also, with these increase of cost in goods and services, we see the devaluation of the currency of that specific economy. Right now, in 2022, we're experiencing a global inflation crisis. But in America specifically, it's fairly interesting to see that the US dollar is actually incredibly strong. We're not seeing the devaluation of the US dollar. And I'm actually going to show you how I know that the US dollar is incredibly strong by showing you some index graphs. So what you're seeing on the screen now is the DXY, or the US dollar index. Now, as the DXY goes up, the US dollar is seen as strengthening, while as the DXY goes down, the US dollar weakens. This is a very good way of analyzing and figuring out when the US dollar is incredibly strong and weak. And I'm actually going to show you some trends when comparing the DXY to inflation rates. As we can see in 2022, the DXY is up significantly, and this indicates that the US dollar is strengthening. We can also see, based on the inflation rate graph, that the inflation rates are also increasing. However, if we compare 2022 to something like 1977, as we can see in the inflation rate graph, we see that inflation rates are increasing significantly, but the DXY is actually down. This is a completely different chart that we're seeing compared to 2022. This also indicates that the US dollar is weakening. And even if we compare the times between around 1980 to 1985, we see that the DXY skyrocketed, which means that the US dollar strengthened incredibly, but inflation rates were seen decreasing. And this actually shows that 2022 is a very different time for America right now. We're seeing inflation like we haven't seen before in a while, where the DXY is up, but inflation rates are also increasing, which also means that the US dollar is strengthening with it, which is completely different compared to previous trends that we've seen. So based on the DXY, we learned that the US dollar is actually incredibly strong right now. Now, the graph that you're looking at is the euro to US dollar conversion chart. And this just shows you that other countries aren't actually doing as well as America's doing in terms of their currencies. We are seeing the euro drop significantly compared to what it was in around 2021, when inflation wasn't that big of an issue. We've seen it drop from around 1.22 to 1.01, and we haven't seen this drop all the way, as you can see by this horizontal line, since 2002, or dropped since 2000, or as we know as the 2000 dot-com bubble. This is actually fairly significant and really indicates that America is actually in a pretty good place in terms of the US dollar strength, as we've seen be DXY, but other countries such as Europe, which rely on the euro, are experiencing high inflation rates, but also experiencing the devaluation of their own currencies. So what you're seeing here is actually the consumer price index, and the consumer price index averages out the increase or the decrease of product prices within each specific index. Currently, I'm showing you the average of all items, energy, and new vehicles. And as you can see right here, we're actually seeing all items at 8.6%, new vehicles at 13.2%, and energy at 34.6%. These have skyrocketed from their previous prices and previous percentages on the CPI. And as we said before, in inflation, we know that inflation is the measure of the cost of goods and services. And the consumer price index measures the current prices of each and every index possible. So the CPI, or the consumer price index, is actually a very good way of measuring inflation, as they both correspond with each other. now that I've actually taught you how to measure inflation, it's time to look at different indexes and see what to avoid and what to buy during times of inflation and what I think are the safest bets to actually get into. Now, I really believe that you should avoid startups. Startups are very risky during periods of inflation, especially due to the amount of cash flow that they have on hand. Startups need cash to continue their production, and they could have the possibility of not being able to meet demand because demand is so high during these times right now. And examples of these startup companies, if we're specifically talking about, let's say, the electric vehicle industry, they could be Rivian, it could be Lucid, it could be something like Polestar. These stocks I just wouldn't recommend getting in right now. I feel like they're a bit too risky during these times. They may be good long term, but for now, there's a lot of uncertainty regarding how the company may function. And I also think you should definitely avoid tech in terms of the NASDAQ if we're talking short term. The NASDAQ is known to drop significantly during periods of inflation. Right now, the NASDAQ is down more than 30% from its all-time high, and that's just a little bit too risky for me. I do believe that the NASDAQ definitely does have a future long term, but in terms of the short-term market, it's just too risky. We're seeing, especially with the current chip shortage going on right now, there's a lot of uncertainty regarding the production of these companies as well. Companies, for example, like Apple, Microsoft, Google, anything in the FANG industry, or, for example, Meta, these are just too risky to get into right now. And I also think people should avoid low dividend stocks. I really dislike low dividend stocks during periods of inflation because basically dividends help minimize the amount of risk that you're giving by giving you a certain amount of money possible. With low dividend stocks, you're basically risking your money and you're not getting anything guaranteed to come back to your account. And it doesn't minimize risk whatsoever during, economic downfalls within the market. It's just too risky. And before we move on to actually what indexes I think do extremely well and what you should get into right now to stay safe during inflation, let's actually talk about interest rates because this is actually very important. Why does the Federal Reserve actually increase interest rates in the first place? Well, as we said before, during periods of inflation, demand skyrockets. It is extremely high. And the whole point of increasing interest rates is to prevent the amount of cash flow within the American economy. Increasing interest rates allows the government to basically reduce the amount of demand for companies. For example, let's say if interest rates go up, it's going to deter people from wanting to get mortgages or regular loans to buy their cars, and it could help reduce the demand, which reduces the prices of the housing market, reduces the prices of the automotive market, etc. And it just allows businesses to actually make a little bit more money, especially if they decide to keep their money within a bank account with incredible amounts of cash flow. And now on to the industry that I do believe is amazing to hold long term, especially during periods of inflation: the insurance industry. The insurance industry is all about cash flow. And like I said before, increasing interest rates allow insurance industries to actually gain money as they have the possibilities to reinvest in high interest rate government bonds, which allow them to receive money back in the long term. They also have the ability to keep their money in the bank, receive more money as they are incredibly heavy with cash. Examples of this, for example, can be Travelers, United Healthcare, Progressive. The whole entire insurance industry has bloomed during this time of an economic recession, and I do believe that it still has the potential to continue to go up, especially as inflation isn't really taming down that much right now. I do also believe, to finalize, that stocks with good balance sheets, stocks with good dividends, those are what you should definitely try to consider or get into. Like I said before, you should avoid low dividend stocks, but you should definitely buy high dividend stocks, as once again, they minimize the amount of risk that's possible. They guarantee a certain amount of money back, even though you're risking a greater amount of money. It's just better overall, and that's definitely what I think people should get into right now. So throughout this course, you've learned what inflation is and exactly how you can analyze indexes to determine whether inflation may be increasing or decreasing. You've also learned what sectors I believe you should avoid or consider as a safe haven. If you have any questions or comments about today's course, feel free to leave them in the comment section below. And thank you for watching. Stay tuned for upcoming sessions.